We're going to learn today how to make journal entries, and the first thing we're going to look at is determining what accounts to use and then how to determine whether to debit or credit those accounts throughout the year. The first slide is going to be dealing with the types of accounts. We have 6. This one shows 3 of those accounts. Assets are resources that are owned by the company and are things like your buildings, your land, your machinery, your supplies, your inventory, your cash, and accounts receivable. The liabilities are cash or services that are owed by the company. So I've bought something or received money in advance, and now I either have to pay what I purchased, or I have to provide services for what I received the cash for. Or another way of thinking of that is these are creditors' ownership of the assets. Finally, on this slide, the capital represents owners' ownership of the assets. So the owner's part of the assets will be determined by the balance in his capital account. The next slide shows withdrawals, revenues, and expenses. These are the remaining 3 accounts. There are a total of 6, and the withdrawals represents amounts that the owner has removed from the company in the form of assets, either cash or other assets, and he needs to remove assets in order to pay for his living. We're talking about the type of organization here, whether it's a sole proprietorship or a partnership where the owner does not earn a salary. So the only way he's going to pay his living expenses is to withdraw assets from the company. Revenues are types of accounts that generate income from providing goods and services. Revenues do not mean cash, because every time you provide services, you might get paid for them now or you might get paid from them later. The revenues that are generated for providing services, for example, include if I'm Joe's Lawn Service, I cut the grass, I've generated revenue. Or if I'm an advertising company and I produce an ad, I've generated revenue. I'm an accountant, I do a tax return, I've generated revenue. Remember, that doesn't mean I've gotten paid, but it does mean that I provided the services. It comes with names like fees earned, commission earned, sales revenue, interest revenue, and so the revenue accounts can be very descriptive. The expenses are the costs of generating these revenues, and there are things like salaries, rent, advertising, maybe even interest and other types of costs that are involved. For instance, with Joe's Lawn Service, he has to buy gasoline, he has repairs and maintenance. These are all costs of generating his revenues. Of the 6 type accounts, 3 of them are going to accumulate, meaning that they build throughout the year so that I know at the end of the year the total amount that has been used for these accounts. And the ones that accumulate are withdrawals, revenues, and expenses. These are the temporary accounts, also known as nominal. And at the end of the year, I'm going to close them out so that next year I can begin anew and figure out how much I spent for revenue expenses or generated in revenues, or the owner took out in withdrawals for the entire year. Now we're going to look at the concept of a normal balance. Of these 6 accounts, 3 of them have normal debit balances and 3 have normal credit balances. And by the term normal, it just means that I increase on that side of the account. Each account has a debit and credit side, and the normal balance is the side you add. The 3 accounts that have normal debit balances, so I add by debiting these accounts, are assets, withdrawals, and expenses. And it's easy to remember if you remember the word AWE, A-W-E, that stands for the first initial of each one of these accounts. So AWE accounts have normal debit balances, and you can expand that to the word awed. 3 accounts have normal credit balances, so I add by crediting to these accounts, and they are liabilities, revenues, and capital. And so because they have a normal credit balance, if I credit them, they will increase. The rule of debit and credit means that if I do the same thing to an account, debit accounts with normal debit balances, I increase it, or credit accounts with normal credit balances, I increase it. Whereas if I want to decrease these accounts, I have to do the opposite of the normal balance. So if I do the same thing, I increase. If I do the opposite, I decrease. So if I want to decrease one of the accounts with a normal debit balance, like an asset withdrawal or an expense, I have to credit it. Credit is the opposite of the normal debit balance. To decrease a liability, revenue, or capital account that has a normal credit balance, once again I have to do the opposite. So if I want to decrease these accounts, I debit those. The steps in making a journal entry are 4. The first thing to do is to analyze the transaction and determine which accounts are affected. The minimum number of accounts you can use is 2 because I'm dealing with an accounting equation and I have to keep these in balance. You can use more than 2 accounts as long as the total of the debits equals the total of the credits. Often step 1 is the most difficult part for new accountants to learn because it's hard to figure out what accounts to use. Step 2 is to determine the normal balance of the accounts that you determined in step 1. So once I figure out the accounts, then I have to figure out what their normal balances are. Step 3 is to decide whether you want to increase the accounts, meaning there's more of them today, or I want to decrease the accounts, meaning I want to lessen them today. If I want to increase, I do the same thing as the normal balance. If I want to decrease, I have to do the opposite. Step 4 is to actually make the journal entry. So here's a transaction. Let's study it and analyze it and see what we can do. Mary purchased supplies on account in this transaction for $75. Well, I'm looking at it. I know that she bought supplies, so supplies is one of the accounts. And I know because it said on account, she didn't pay for it now. So on account means that she owes for it. Accounts payable is the other account. So the accounts in step 1 are an asset, supplies, and a liability, accounts payable. Step 2 is to determine, well, supplies is an asset, so it has a normal debit balance, and accounts payable is a liability, so it has a normal credit balance. So now I know the 2 accounts, supplies and accounts payable, and their normal balances. Supplies as a debit, accounts payable as a credit. Step 3 is to determine, do I want to increase or decrease these accounts? Well, if I bought supplies, I have more of them, so I want to increase that account. So I would have to do the same thing to it as its normal balance. And if I have an accounts payable that I now owe more money, it means that accounts payable also is going up, so I want to increase that account. And so here is an example of a journal where I could actually put the amounts in. The first column deals with the account that's debited, the second one with the account that you're going to credit, and then the third and fourth deal with the amount debited and credited. Notice that the debits and credits always have to be equal for each transaction that you record. Because supplies is an asset with a normal debit balance and I want to increase it, you can see I'm going to debit the supplies account for $75. Since accounts payable is a liability with a normal credit balance and I want to increase that, I will credit accounts payable for $75. We have just entered our first journal entry, and hopefully this helps make some sense. Thanks.